Bill Ackman is the founder and manager of Pershing Square Capital Management, a hedge fund based in New York City. The hedge fund has around $8 billion under management as of June the 30th, 2019. You may know him for his famous battle against Herbalife, where he took a huge short position due to his conviction that the company is a pyramid scheme. Bill Ackman is widely known as a great investor on Wall Street. He has outperformed the market by over 600% between 2004 to 2020. But short-term trading is not for everyone. You need to be fast, confident, and willing to admit when you're wrong. Number 7. Applying what happened yesterday today. A very common mistake that many day traders make is to apply what happened in the market yesterday today. Perhaps you made some money shorting a stock on Monday. You shouldn't assume that the same thing will happen on Tuesday. In other words, a market is usually a dynamic place where things change regularly. You can avoid this by looking at the market with different lenses every day. If you made a big profit yesterday, remember that the situation can change and you can make a big loss today. Therefore, always have a journal that highlights some of your profits and what caused them. This will help you avoid making this mistake. Number 6. Penny stocks. Penny stocks are the biggest portfolio killers. Low-priced, over-the-counter stocks have much fewer requirements than the stocks on major exchanges. The one quote from the Wolf of Wall Street is, "Rich people don't buy penny stocks. They just don't. Why not? Because they're too smart. That's why not." The Wolves of Wall Street are still out there, but not as brokers like in the movie. They now come in the form of stock promoters and executives of fake companies. I know enough of their tricks to write a book. Ackman's penny stocks are a special case though. He has investments in Fannie Mae, FNMA, and Freddie Mac, FMCC. As an activist investor in the companies, he and other fund managers have taken legal action against the US government. They have a legitimate gripe and they succeed. These companies were bailed out by the government during the financial crisis by selling preferred stocks with a 10% dividend. Since Fannie and Freddie could not pay the 10% rate, the conditions were changed to the dividend being all of their profits. Since then, the companies have paid $247 billion in dividends, according to the bailout tracker on the ProPublica site. In comparison, the bailout was for $187 billion, but Fannie and Freddie have not been allowed to buy back the preferreds since all of the profits have to be paid as dividends. If the legal case against the government works out, the investment could be a 10-bagger. If not, these stocks are worth nothing to the shareholders. It's a gamble. In November of 2013, it was disclosed that Pershing Square held 115 million shares of Fannie and 63 million shares of Freddie. Since then, the stocks are down 16.6% and 20.7% respectively. If you decide to invest in penny stocks, invest in companies that you know. Also, you can check with the investing gurus that are tracked at Guru Focus. They have done their homework. Number 5. Not all trades will go your way. One of the best performing trades by Ackman was a short call for a company called MBA that insures municipal bonds. After placing the short trade, this trade was in the negative for more than 7 years before the company's shares fell from $70 to $1. He earned more than $1 billion from the investment. Many investors shorted Herbalist after Bill announced his investment based on his historical success. Unfortunately, the FTC announced that though Herbalife had some problems, they didn't amount to the pyramid scheme Ackman claimed they were. The shares are now on an upward trajectory, and Ackman will have to liquidate after spending more than $50 million battling the company. As a trader, this is a major lesson you should learn. Not all trades will go your way. Today, your bullish bet on Brent oil could make you good money, while tomorrow the same bet will cost you a fortune. Always position your trades knowing that they might go wrong. Number 4. Expecting to be perfect. A common mistake that many day traders make is expecting to be perfect. After going through months of preparation and studying, they expect to open trades that are always profitable. In reality, this rarely happens, even to experienced traders and investors. There are many examples of experienced traders who have made serious mistakes. A good example is Bill Huang, an experienced trader and billionaire who worked for Tiger Global Management, a well-known hedge fund. In 2021, his over-leveraged trades led to a significant loss in the market as investment banks activated their margin call. This led to banks like Nomura and Credit Suisse losing more than $6 billion combined. In this instance, an experienced trader with billions of assets was not affected. Bill Ackman is another famous hedge fund manager who lost billions of dollars after his bet on Valeant Pharmaceuticals failed. Therefore, as a trader, always remember that you will never be perfect. Not all trades will go your way, therefore you need to take some actions to prevent these challenges. For example, always size your trades well, have a stop loss, and be ready to change your mind. Number 3. Be ready to walk out. Another thing you should learn from Ackman's troubles is the need to walk out when your investment thesis doesn't seem to work out. The best company to illustrate this is Valeant Pharmaceuticals (VRX). For many years, Valeant was the darling of investors. They flooded the company, raising the shares from less than $30 in 2011 to a high of $257. In 2015, the company problems started when Hillary Clinton talked about regulating the pharmaceutical industry. VRX was notorious for hiking drug prices. This was coupled with the fact the company had borrowed massively to buy drug companies. When these problems started, Ackman had an opportunity to exit, but he didn't. Forbes now estimates that Ackman has lost more than $1 billion. Number 2. Not having a tested and proven trade management plan. Successful traders and investors have a system that has been successfully tested and can write down when to buy and sell a stock. Systems can range from day trading, value investing, Can Slim, Warren Buffett's 90-10 S&P 500 per cash strategy for his beneficiaries, to simple dollar cost averaging into a target date fund. In Pershing Square Holdings' 2015 annual letter to shareholders, Ackman discussed some of his errors. Principally, we missed the opportunity to trim or outright sell certain positions that approached our estimate of intrinsic value. When the stock Valeant VRX price rose this summer to the mid-200s dollar per share, we didn't sell as we believed it was probably the company would likely complete additional transactions that would meaningfully increase intrinsic value. In retrospect, this was a very costly mistake. We made a similar error in not trimming our Canadian Pacific CP position when it reached $240 per share. These errors dealt with buying and selling at the wrong time. He has a system outlined and respect that he admitted to his errors. With a solid system, an investor can write down when to buy and sell a stock. The system would prevent these types of errors and not lead to statements such as, "I should have bought here," or "I should have sold there." Number 1. Falling into the pressure of reaching a certain financial target in a trade. Being a full-time trader means you fully depend on trading to cater to your bills and sustain your lifestyle. Such a scenario will make you trade haphazardly as you strive to make a specific amount of money in a trade. Instead, the key to being a successful trader is discipline and sticking to your trading strategy. In day trading, you eat what you kill, meaning that there's no salary at the end of the month. You'll only make money that you generate from the market. Fortunately, you can do your job and day trade simultaneously because many trading platforms offer mobile apps to trade. You can access these apps wherever you are. When the markets close, a trader doesn't necessarily have to stop trading. This is thanks to after hours. Of course, there are many more limitations than standard hours, but it's an option to consider if you want to familiarize yourself with the markets little by little. What's your opinion about Bill Ackman? Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel, hit the bell icon for more updates and notifications. Stay safe, and we'll be back soon with another video.